We ended the week looking fairly strong in the S&P, with many companies rebounding very sharply, including some of the Mag 7, but in particular today we want to uncover Intel, what has happened with this company, and actually just over the last few days, like the semiconductor space, they are up nearly 6%, although you can look around and see whilst it has gained, it is one of those with the smallest percentage increase. And the reason we want to put this company under the spotlight is because they just reported their earnings after the market close on Thursday, and as a bit of a spoiler alert, it did look like many Wall Street analysts just didn't like what they had to hear, and we get JP Morgan, one of many in fact that have lowered their price target, and whilst it was at $23, they've now put this at $20 and do believe it does deserve an underweight rating, something that we'll take a look through our own valuation process. But if we look at year to date, the S&P as a whole has been fairly mixed depending on whether or not your portfolio has been heavily weighted in the Mag 7 or spread across other industries. And actually when we look at the semi space in particular, while some of the larger names like Nvidia, AMD, Broadcom, TXN have been hit very strongly, double digits, Intel is now sitting flat on the year, so whilst you wouldn't have lost any money at this point in time, unlike others, you would also gain nothing as of now. So we want to understand, for a company that is down nearly 7% after releasing their earnings, a company that has been battered down 43% over the last 12 months, one trading near its 52-week low, is it a great contender for a turnaround play? Is this one we should consider adding to our portfolios for longer term gain, or is it actually a trap and one we should steer clear of? Now we will point out that all three analysts are in agreement, Seeking Alpha, Wall Street and Quant, that this company as of now is a hold, and if you've been a longer term shareholder, well, not good news unfortunately. Over the last 10 years, this company is down 40%, so 10 years ago today, if you invested $10,000 into Intel Corporation, you would actually have only around $6,000, so unfortunately it wasn't a great opportunity back then. Question is now time to start adding to the portfolio? And we can see its 52-week high is sitting at $37, which is nearly a double from the current value. We'll also point out on the valuation grade, it does look fairly favorable at a B-, yet if we look at the forward P at 44, that is pretty high considering the sector sits at around 20, so you're paying a 124% premium against the sector, but also in relation to their own 5-year average, it is trading around 53% higher, so a premium on both accounts. That if you're someone that does like to look at other valuation metrics, for example, on a price to book, it is looking incredibly attractive, trading at a 75% discount to the overall sector, a 53% discount in fact to their own 5-year average, and that is pretty much the same when we look at a price to sales, 30% discount to the sector, 33 in fact to their 5-year, and the same conclusion on the price to cash flow as well as a few others. So let's dive in and see whether or not this is one to consider, and the best place to start is their earnings report, which as the headline suggests, they did in fact issue weak guidance and they're going to slash expenses, something that we've also seen in 2024. So it does look like at the moment, just based on the headline, that they are still continuing with their struggles. In terms of their numbers, well, EPS did look fairly well, 13 cents versus market expectations of 1, and they also beat on the revenue, so a double beat, 12.7 billion, analysts were anticipating 12.3. However, one thing that the market didn't like and probably did go some way to seeing this drop was it for the next quarter, or the one we're currently in, they're estimating 11.8 billion to the top line, which is pretty much 1 billion lower than market forecast of 12.82. And we can also see not great news on the EPS as well. Intel are anticipating to break even, $0 EPS, market wanted to see profit of 6 cents. And they do believe trade policies does go some way to explain some of the issues they're facing, and they believe there is now an increase of an economic slowdown and potentially a recession, which will ultimately affect this company and quite widely. We also should point out that for this quarter, they did in fact report a net loss of $800 million, and this was unfortunately worse than the same quarter last year, where again they did report a loss, although smaller, at $400 million. So this company is continuing in that struggle they have seen now for quite some time. But you could also argue that the CEO, who did in fact just come in place a few months ago, does deserve a bit of time to really turn the company around. But as we will show you you already, investors are starting to get a little bit worried about the promises that they were sold by the new CEO, and unfortunately the expenses that they are looking to cut are going to be quite largely in terms of the number of jobs, with the number anticipated to be around 20,000, and they're also going to reduce their capital expenditures. As we said, some part of that they do put the blame on the tariffs that have been put in place, and as we have seen in other earnings, other calls, a lot of the CEOs are starting to blame the uncertainty, the volatility in the market, which also moves on to consumer behaviors, consumers getting more anxious, and that in turn is now reflecting in the numbers and the guidance. And as we said, 20% of their staff are now on the chopping board. Perhaps something that does sound familiar, because in last August, where they also reported a fairly weak earnings, they were talking about expenses to be cut 15% of their workforce, which at that time equated to 15,000 employees. But on top of that, they also reduced their dividend from Q4 and continued with that narrative of reducing capital expenditures. This is definitely signs of a company that is really struggling. And as we said, investors are starting to worry this weak outlook. Even though a new CEO is in play, they do feel like some of these promises are looking more and more difficult to obtain. And we also want to highlight here something that we did hear from that latest earnings call, where the new Intel CEO said he did speak to the Taiwan Semiconductor's CEO, where they were looking at areas of possible collaboration, and as we can note here, a win-win situation. It's also worth reminding that just a few months ago, the company did push back their very large project, the 28 billion factory, in fact, in Ohio until 2030. So there are a lot of things that are really going against this company, and that is also shown in these quarterly earnings. In fact, they have been shown through quite a vast number of them. So this Q1, 12.7 billion on the top line, it's down 0.4% on a year-on-year basis, which when we put this into perspective and incorporate 4% in terms of inflation, real terms, revenue has been decreasing. Gross margin 39.2%. It is also down nearly 6 percentage points from the same quarter last year. Now remember, we always say high quality companies show us two things. One, an increase in revenue. Two, an improvement in efficiencies in their margins. Intel unfortunately have done the opposite on both accounts. And we also noticed their earnings per share 13 cents, which is down 5 from the same quarter last year. And we can also see that in this graphic, not looking good, at least in terms of the historical performance. And if we do want to factor in the quarter that is upcoming, Q2, they're anticipating their revenue to come in down 1 billion from the same quarter last year. Again, a reduction in their margins by 2.2 percentage points, and earnings per share to be pretty much flat. As we said, break even. Analysts wanted to see this around 6 cents. Last year, in fact, it was sitting at around 2. We will also mention, though, over the last 4 quarters, in terms of this company and where they've been, they've outperformed in their 2 most recent quarters, giving them a 50% track record. And in fact, over the next 4 quarters, it isn't looking that much brighter. But if we look at their full accounting period for the next year, December 2026, they will be trading at a forward P of 23.4. But that again is only if you have faith they can hit those numbers. And what's very interesting to note is when we look at super investors that hold this company, as always though, they are starting to trickle in. As more and more come in, we will bring to your attention, especially the likes of Warren Buffett, Bill Ackman, Bill Gates, so make sure you're subscribed. Though we can see for Intel in quarter 1, what we do have at the moment is the Hillman Value Fund that fully sold out of Intel Corporation. That was a 2% position in their portfolio, but I'm sure, as you're aware, many super investors hold a wide variety of companies that typically don't make up more than 2 to 3% of their portfolio, and it's something we also noticed in the previous quarter. Many super investors were either reducing their position or in fact fully selling out. We'll also show you what the institutions have been doing with their 65% ownership. They sold 7 billion worth of shares over the last year. They bought quite a lot more at 10.1, so you could argue, at least over the last 12 months, a lot more bullish than bearish. However, we should make you aware, at least in the most recent quarter, 249 million worth of shares were sold, 117 million were bought. So actually in 2025, so far based on this data, it does look like institutions are more bearish than bullish on Intel. Likewise, we'll do a quick analysis of insider ownership, very low at 0.04%, $500,000 actually worth of buying at least over the last 12 months, and in the same time frame around 650,000 worth of selling. What we will in fact say though, Q2 no movement, Q1 no movement, Q4 was where we saw the selling of 650k, Q3 was where we got partial buys. Given these are outdated, nothing in 2025, we won't really look into it too much. But remember, insider buying, in our opinion, bullish signal. Mandarin buy, they believe the share price will go up over time. Insider selling, not necessarily bearish. They sell for many reasons, personal and financial. Now jumping into their financial metrics, kicking off with the free cash flow. However, earnings data is susceptible to manipulation by management through accounting. So looking solely at free cash flow, which we would like to increase over the longer term, at least on a consistent basis, it has been negative over the last 3 years, and even over the next 12 months, anticipated to continue that negative trend. $1.75. Again, not something we ideally want to see. In terms of sales growth, minimum 3 to 7%. At a bare minimum, this is just to keep up in line with inflation at the 3 to 4%. Last 3 years has been negative, trailing 12 month also negative 4%. And if you look at it on a numerical basis, we actually get to see in 2021, it hit the highs of 79 billion. Ever since then, it has only been coming down, and actually what they reported on their revenue in 2015 at 55 billion does sit higher than the revenue in 2024, so you can already see there are a lot of issues solely based on a financial perspective. And then we move on to the shares outstanding, where we love companies that do share buybacks, returning excess cash to investor pockets. We see this actually decrease over the last 10 years. But actually, if you're someone that's bought in 2021 or onwards, they've done the opposite and they've been diluting your position as a shareholder whilst the share price has also been decreasing. Not something you want to see. Again, factors just to take note of. In terms of ROIC, 10% or more, give us faith, Mandarin are able to effectively allocate their capital. Looking great, 2015 to 2021. Since then, it has in fact been decreasing, and 2024, we do get negative 2%. That is not a great sign, something that we will be able to see when we look at the income statement shortly. And then we get to the margins. We already covered this not too long ago. Their margins have actually started to decrease. And we also noticed in 2024, negative 7%, which means they reported a loss, something we will highlight. And free cash flow, no surprises here, given they were free cash flow negative over the last few years. Lots of things, again, just to bear in mind. Doesn't mean the company isn't investable, but when you do have a look at your investment thesis, there are a lot of things you do need to consider. We then move on to the net debt to EBITDA. Now remember, this correlates to balance sheet strength. We want to see a maximum of 1.5 for the semiconductor space. It's been above that since 2023 and only increasing, with the numbers here reflecting the number of years it would take the company to pay off all of their debt net of cash on hand. Granted, it is anticipated to come down over the next 12 months. They're implementing the continuation of cutting expenses. Nonetheless, it is still very high and something we will flag when looking at the balance sheet Now, in terms of their growth, it does come in at an F. Year-on-year revenue, negative 2%. Forward-looking, positive 1.5%, well below the sector in the mid-single digit. And over the last 5 years on average, and this is a terrible metric to have, their revenue has actually been decreasing, negative 4% and negative 2% respectively. Again, things just a factor, but what we don't have is the EPS expectations over the next 3 to 5 years. As we can see, the sector-wide is around 14%, their own average sits at 10%. In terms of profitability, they do get a B+, but look, their gross margin is 34%, sector a lot higher at 50%, their own 5-year a lot higher at 48%. Bottom line, negative 35% as they reported a loss. Sector sits at 4%, whilst low, at least positive. And over the last 5 years, on average, it has sat at 12.4%, which was historically above the sector. In terms of cash from operations, while looking very strong at 8.3 billion, given the sector sits at 108 million, we can notice there's a significant drop from their 5-year average at 22.2 billion, and something we would say needs to be rectified. Now, for those that do want to see how their performance is against others in the space of a similar size, Analog Devices, Micron Technology, as well as a few others, over the last year, negative 42%, not only the worst performing, but we can see as a whole, the industry just hasn't been that great. Nonetheless, they have had the largest fall at 42.3%. When we expand it to over the last 5 years, we can see they're the only company with negative percentages, negative 62%. Others have performed fairly well in the positives, vast majority triple digits. And over the last 10 years, again, the only company that is down, negative 22%. Others have actually performed very strongly. So you could argue this industry over the long term, if you had picked the right names, was actually a very strong performer in your portfolio. But as we always say, past performance is not an indicator of the future. And for those that just want to see it against the S&P, Intel's down 42 over the last year, S&P up 9. Over the last 5 5 years, negative 62% performance for Intel, S&P up 92, and over the last 10, Intel down 22%, S&P up 162. Now look, it could be a turnaround play over the next 10 years, it could massively outperform, but if you don't have that faith, always do consider here an ETF maybe that tracks the S&P 500 like VO. Otherwise, you do need to have some strong convictions that these companies you are considering, at least on an individual basis, can severely outperform. And as we said, their revenue over the long term has actually been decreasing, at least in the most recent period, going from 55.4 billion in 2015 to now sitting at 53.1. That is lower in 2024. But we also want to understand, what does the bottom line net income tell us? What is the overall trend there? And we can actually see not only very, very inconsistent, but whilst they reported a net profit of 11.4 billion in 2015, most recent year a net loss of 19 billion, and we can see again on a year-on-year basis very, very inconsistent, at least from 2020, where in fact it has been moving on a continual downward trend. Then we can do a quick health check, total cash versus total debt, where the cash has also been fairly inconsistent, going from 25 billion 10 years ago to now sitting at 21, which may look very good in isolation, but as always, we never just look at one figure here. We like to compare it for a quick health check against the total debt, both numerically and directionally. And what we can see when we take a look at this metric, it has been maybe one of the most consistent things about the company. Their debt levels continue to rise. 23 billion 10 years ago, more than double now to 50.2, and that is why we did raise the issue of the net debt to EBITDA, at least for now, something we will continue to look at on a quarter by quarter, year-on-year basis. Now, the CEO did in fact point towards the wider economy, tariffs, and we can see investor sentiment is still fairly bearish. We are in fear, although just a few weeks ago we were sitting extreme fear, something perhaps just to bear in mind when looking at a company like Intel, where the wider global economy will affect their numbers. But if we look at the overall market in terms of a forward valuation, lots of patches of red, which ultimately means companies could here at these levels be overvalued. There are some greens, which is perhaps maybe where we should be looking at for opportunities. And if we look specifically in the semiconductor space, we can see Intel, based on the figures here, trading at a forward valuation of 24.25, which maybe looks less of an opportunity when you compare it to the likes of Nvidia, trading much lower in the 19 to 20 region, Micron Technology even lower, as well as Qualcomm. But again, this should just be one thing to incorporate in your overall investment thesis. And before we jump into our own valuation, just to let you know, we have released our latest free weekly article. We draw one every single Monday morning to your inbox completely for free, where we cover severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away, where you'll also be able to grab a list of 35 severely undervalued stocks, lots of information for each one, as well as the upside that Wall Street themselves see over the next year. And you can also grab a copy of stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. We then move on to our intrinsic value for Intel, which sits at around $26, derived from the DCF model. And as you can see, we have the free cash flow year on year. In fact, average growth is negative 15%, as we've highlighted a few years, in fact, at least in the most recent, where it has been negative. And moving forwards, we have gone for a growth rate of 0%, although we have to bear in mind this is a fairly subjective model, given that we have used the starting point of 2025 around the 9 billion mark. This is what we did see before they were reporting negative free cash flow, and something we would say just to consider when looking at this model. But if we do use 0% growth moving forwards based on the 9 billion and the discount rate, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and we get to $26, which does indicate 30% upside. And as you can see, we do have the low, medium, and high. Numbers here, as always, are subjective. You can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for Intel or any others. But we'll show you at 4%, it comes to $35, upside of 75%. And at 8%, we can in fact see $47, upside of $135, more than a double from the current price. Reason why we have gone for the 0% growth rate, as we can see already, the company is struggling significantly, but we've also used a future free cash flow, at least for 2025, in one that we do believe they won't be able to achieve. So we've gone extremely conservative on the growth rate, and we're not done there, because we would like to apply a fairly hefty margin of safety again on this basis, and we always start off with 10%, execute on on that if it meets our 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. If you believe that today, a buy at around $23, $24, and then we keep going till it's near the current trading price. And as you can see in today's episode, around a 20 to 25% MOS. Wall Street themselves, they gave it a hold rating. Many analysts did in fact cut their price target, on average sitting at $23, in turn translating to 15%. So in your opinion, Intel Corporation, 20 to 25% MOS, 15% upside. Do you see it as a buy, hold, or sell? And we can in fact keep on going for those that want to see. At 25, as noted, $19.62. At 30%, around $18.31. 35 around $17, and at 40% around $15.70. As always though, give us your thoughts: 20 to 25% MOS, 15% upside, Intel Corporation a buy, hold, or sell. And don't forget to sign up to the free weekly newsletter, grab those spreadsheets, come and join us on Patreon where we cover our weekly buys and sells. And as always, have a great day. We'll see you all on the next one.